Shearman and Sterling is a full-service global law firm. Shearman has 24 offices and over 850 lawyers around the world. Shearman's real estate group is involved in all the traditional categories of real estate practice, including real estate finance and investment. We are pleased to offer this webinar to our clients and friends. Shearman's real estate team gathered a panel to provide an update on a variety of regulations currently affecting bank lenders of U.S. commercial real estate. Our panel includes partner Malcolm Montgomery. Malcolm is the global head of Shearman's real estate practice. His practice spans domestic and cross-border investment and finance, and leverage lending and bank finance for REITs and other real estate companies. He advises on workouts and restructurings of construction, permanent, and mezzanine loans and credit facilities. Michael Pettingill is a counsel in Shearman's real estate group. Mike advises clients in a wide variety of lending and structured finance transactions. Zachary Aries is an associate in Shearman's real estate group. Zach advises lenders, developers, and REITs in complex financing transactions. The panel will first discuss recent developments relating to the phase-out of LIBOR and the transition to the alternative reference rate SOFR. They then discuss the Federal Reserve Board's Regulation W, which imposes quantitative, collateral, and safety and soundness restrictions on certain covered transactions, such as a bank's loans to its affiliates. Next, they will update us on the latest reform measures relating to the treatment of loans characterized as high volatility commercial real estate, or HVCRE loans. The panel then dives into the new beneficial ownership rules imposed on banks by the Financial Crimes Enforcement Network under the Bank Secrecy Act. The panel then provides an update on both the National Flood Insurance Program and the Terrorism Risk Insurance Program. And last, the panel discusses the Federal Reserve Board's Qualified Financial Contracts Final Rule, requiring certain banking institutions to amend QFCs to prevent their immediate cancellation or termination if the firm were to enter bankruptcy or a resolution process. Although the panel addresses a variety of different subjects, this webinar is not meant to be an exhaustive presentation of the topic. If you have any questions or would like to discuss any aspect of the presentation, please do not hesitate to reach out to any of the presenters.
Obviously, folks haven't heard, LIBOR is going to go away, most likely. So wanted to give a little bit of background on that before we get into the nitty-gritty. I think, as everybody knows, LIBOR is a London interbank offered rate. It's the sort of wholesale, supposed to be the wholesale lending rate between banks for term loans. Currently exists in 5 currencies, has 7 different terms or tenors. And we get it because 20 different panel banks give quotes on a every business day basis, and LIBOR, as folks know, governs trillions of dollars of transactions. So why are we talking about replacement of LIBOR? The LIBOR is by its nature subject to manipulation. And during the financial crisis, it came out that it, in fact, had been manipulated. One trader said, going back to '91, traders had been sort of, playing with the quotes. It really came to light because during the financial crisis, banks were hesitant to lend to one another. So, people didn't have, actual transactions to quote. So when this all came out, obviously there's a lot of lawsuits and finger pointing, and the regulators started to act, and they appointed the Intercontinental Exchange Benchmark Association to take over the administration of LIBOR in 2014, and the Fed constituted the ARC, the Alternative Reference Rates Committee, in 2014 to investigate sort of reforms / replacement of LIBOR. So that was the background. And then, a big event was in July of 2017. Andrew Bailey of the FCA basically gave a speech and said that, while great strides have been made around the controls of submissions, LIBOR is becoming problematic because the markets, the wholesale lending markets among banks were no longer sufficiently active, and without much activity, banks were sort of forced to use their expert judgment to come up with quotes for, to submit on a daily basis, and um, that is, subject to manipulation, right? Expert judgment. So um, the currently the FCA has the power to compel banks to submit quotes, but I believe that runs out. Of course, they have, the power of persuasion, right, to compel, to persuade the banks that they regulate to provide these quotes. But Bailey came out and said, we're not going to do that past the end of 2021.
I mean, let's face it, with the risk of trillion-dollar lawsuits on the line, no bank wants to quote LIBOR anymore.
Right.
And so the banks basically said they're getting out of this business, and they were only willing to continue to quote LIBOR for some very limited period of time, knowing that a final deadline had been set by which they could get out of this business because it wasn't worth the liability. And you could argue that it was the bank's own fault, because it was bankers within the banks who were misquoting LIBOR. However, the reality was, what it just underscored was the fact that LIBOR was so thinly traded. It was subject to manipulation easily, and that's why LIBOR is not a great benchmark for trillions and trillions upon trillions of dollars of derivative and other financial contracts.
Thanks, Malcolm. Yeah, and to that point about how thinly traded it was, I think in one year, maybe it was 2016, they counted in one of the tenors of LIBOR, they counted only 15 qualifying trades in the whole year. And this is something that the banks are being forced to quote on a daily basis, right? So that's the issue. So in Bailey's speech, he said he'd push it out to 2021, at the time, mid 2017. So that gave 4.5 years for the market to figure out how to replace LIBOR without, giant disruption in the trillions of dollars of outstanding. You'll note since as recently as March, the FCA came out and said, yes, we understand the COVID pandemic is complicating things, but market participants should not count on that 2021 deadline being extended. So this is something folks really have to consider. So we'll go to the next slide and talk about SOFR and how that compares to LIBOR. SOFR is the replacement of choice by the ARC. This chart sort of says why and compares the two. Just running down at LIBOR term structure, so it goes out on a forward-looking basis. Whereas SOFR is over an overnight rate. So we'll get into that a little bit more, but that's what's causing a lot of the friction on this replacement. LIBOR is unsecured, so the SOFR rate is based on secured lending. So the rate is determined, based on no risk, because the SOFR loans are secured by U.S. Treasuries, which are supposed to be no risk. LIBOR again reflects the bank's cost of funds, SOFR risk-free rate because it's fully secured, and LIBOR is naturally higher because it reflects credit risks of the bank. And again, SOFR is lower because it's secured. We talked about, the thinly traded LIBOR, thinly traded market in wholesale lending between banks, whereas SOFR currently, last I looked at a chart, probably 8 months has been over $1 trillion. We talked about how LIBOR can be manipulated. SOFR, it's a fact. The Fed has records. And can publish, the SOFR rates going back to 2014. And again, we spoke about how there's trillions of dollars outstanding in LIBOR. I saw one recent estimate, over 200 trillion of contracts are tied to LIBOR, whereas SOFR, There has been issuance, but it's been relatively limited. Let's see. We'll talk about. So ARC is really pushing to go to the next slide, Zach. ARC's really pushing to streamline the process, recognizing the immense amount of financing that's out there that relies on LIBOR. So they're saying for all new loans, they should contain fallback language that deals with when LIBOR ultimately goes away. And the three components are obviously what's the new benchmark, right? How do you determine what the benchmark is? What the new benchmark spread is going to be, and that is to account for parties entered into a contract based on LIBOR today. The LIBOR again takes into account the credit risk of the banks. So LIBOR is naturally higher than SOFR. So if a simple loan, bilateral loan, the borrow if you just switch to SOFR without an adjustment to the spread the borrower is going to have a great benefit rate. It's going to be a lower rate. So that we need to account for that. And then the third component
on that, Mike. Traditionally, the rate difference between SOFR and LIBOR has been 25 to 27 basis points, and for banks, that really is intended to be their cost of capital, and because that's the rate in theory at which banks would lend to each other in the LIBOR market. And so if you take that part out, all of a sudden on every loan tied to a floating rate, if all the rates move to SOFR and you don't account for the cost of capital component, banks are having getting a much worse deal than they were under their LIBOR financings. And the problem we have is that if you asked a bank to compute its cost of capital, I think a lot of banks would have a lot of trouble doing that because it's a very complicated thing. And so LIBOR that was calculated in a way where there was sort of just an average cost of capital built into what LIBOR was, which made it very convenient to use LIBOR as a lending basis because you didn't really ever have to get into the question of what is your cost of capital anyway. But now if you move to SOFR, that becomes a relevant question. And, as the tide goes out, all the rocks appear. I mean, the differences between cost of capital from one bank to another bank or one institution to another may start becoming relevant in the new market, depending on how this all resolves.
Getting back to the fallback language, the third component is the part we want to agree on what the triggers are for the replacement. We'll talk more, but the ARC, you'll hear discussion about the hardwire approach versus the amendment approach. The hardwired approach is, and we'll talk about ARC's suggested waterfall. If this is available, you use this. If not, you use that. It's trying to take the discretion away from the parties, right? So you hardwire how the changes are going to be made, and it will just engender a lot less negotiations and confusion, which is important, right? I think the LSTA estimates that there's currently 10,000 syndicated loans outstanding, right? So if we're trying to, have negotiations to amend every one of those loans, where the result of the negotiations could be winners and losers, it's going to be trouble. That's why the ARC is really pushing the hardwired approach versus the amendment approach, which is sort of like, we're going to agree on what the replacement benchmark would be, a spread would be. We'll take into account prevailing market conventions at the time, but it leaves a lot more room for negotiation and disagreement, which, in placid market times will be very difficult. And, can you imagine if there's a disruption like we've, recently had? So let's move on. Just talk about the potential benchmarks. So we talk about term SOFR is like the holy grail. Everybody wants that because, loan documents, current LIBOR loan documents set the interest rate in advance, and there's no confusion. Whereas, if there's not a forward-looking SOFR, the loan documents are going to have to be amended to change the interest dates and interest periods and determination dates, because it's backward. SOFR will be backwards looking.
Yeah,
so,
one of the big problems with backward looking SOFR is that you don't know how much interest you're going to owe until the interest period has run, and so you really are going to have to look at what SOFR has been in order to calculate what you're going to pay when the interest period expires. And so it's completely different from LIBOR, and so it sort of baffles the mind when you think that someone thought that SOFR, which is so dramatically different from LIBOR, would be a good replacement rate. If term SOFR can be developed in a way that's similar to term LIBOR, then it'll be a great replacement rate, and the risk associated with different terms may be factored in, et cetera, et cetera. But that hasn't happened. And the last estimate we saw was that might not happen, if at all, until late 2021, which is right when LIBOR is disappearing. And so the logistics of moving to a rate that really hasn't been developed yet, and the complications associated with that are cannot be understated. I mean, it's a big problem.
Yeah, that's right. And my own thinking on that is, so SOFR is an overnight rate that you can look at. If you're coming up with a forward-looking SOFR, how do you do it without creating the same issues that you have on coming up with LIBOR, right? I don't know why it would be any different. So again, that's the preference. Create less changes to loan documents, but seems current as we sit here today, it seems sort of unlikely to be the solution. So compound SOFR is compounded over a term. You can look back over 1 month and come up with a figure. Again, backward looking. The New York Fed began publishing amounts for compound SOFR. Simple SOFR, a little more straightforward, just the daily average, over the interest period of what the rate would be. Another potential would be, the replacement rate that ARC recommends. And, a last one would be, the replacement rate that ISDA recommends. And, again, I'm talking about, this is in the discussion in the context of syndicated loans. I should note also that if it's not obvious, the market is really pushing for screen rates on this sort of stuff, the same way LIBOR is, there's screen rates, just to, eliminate the uncertainty. So talking about the benchmark spreads, how is that spread going to be calculated? Is it going to be calculated, on the next slide, you can see it talks about the spot rate comparison, which would be, on a particular day. But obviously SOFR has spikes, you've probably seen, so that makes folks nervous. Compounded in arrears, calculate the spread based on comparing LIBOR to SOFR over a specified term. This is what ISDA is planning on using. Again, it's backward looking, so it won't be available at the beginning of the interest period. Let's see on the next slide, we go into the waterfalls that ARC is recommending. So again, this is the hardwired approach, and it says, if term SOFR is available, that's what we'll use. If it's not, then we'll use compounded SOFR, and if it's not that, the borrower and the admin agent can agree on what benchmark to use, taking into account prevailing market practices. The spread adjustments, a little less certain. In ARC's current waterfall, they talk about the one that they select. If that's not available, it'll be the one ISDA selects, and the fallback is is agreed to by the borrower and the admin agent. I should stop here and say the ARC published materials with all these recommendations and selected language on April 25th, 2019. That's the current state of play. It's due to be updated relatively soon, and that's where that is. So there's a lot of there's all the language is in there, and if you take a look at it, you'll see why the market's been a little bit slow to adopt it, because there's still it's a little complicated, and there's things like language about conforming changes, sort of even in the waterfall. It basically says, we'll pick the benchmark according to the waterfall, we'll pick the spread according to the waterfall, and then the admin agent will go ahead and make other conforming changes to the credit agreement without the consent.
And the reason you need other conforming changes is because if you're moving from a forward-looking rate to a backward-looking rate, you have to make a lot of changes, technical changes to your loan agreement. And you can imagine how the conversation goes with the borrower and the lender, where the lender is saying, well, ARC is telling us that we need to put a hardwired waterfall of interest rate options into your loan agreement, borrower. And the first option we're going to go with will be term SOFR. But by the way, term SOFR hasn't been published yet and isn't available and may never be available. And if it is available, we're going to go with that, even though it has no history. And so, borrowers are looking at that saying, you're not putting that in my loan agreement. How do I know that's going to work? And the lender is forced to say, well, we wouldn't let you lead you down the primrose path into a rate that wouldn't work. So you really should just trust us on this. And the borrowers are saying, yeah, I mean, we're willing to trust you, but we don't know that we're willing to trust you, to the point where we've got a rate in our loan agreement, that has no history and that has only just been developed. And so that's the conversation that's going on. And the result is only about, I would say, roughly a third of the syndicated loans in the market have some kind of hardwired waterfall now, of the ones that are being originated, because, the end of that conversation often is, listen, we should just wait for more clarity to appear around the replacement rates and how they work before hardwiring something into the loan agreement. And so that discussion is being had routinely on every deal that's being done.
Yeah, that's right. The market's been really slow to adopt it, and we'll talk about in another slide. We'll talk about ARC's best practices, but you'll see we're not really there yet. So this slide talks about the ARC triggers. Effectively, this is what triggers the benchmark replacement and the new benchmark spread. Effectively, ICE, the administrator, or one of the regulators, basically says that LIBOR is no longer available, or that it's no longer viable. And there are different industries have different triggers. The ISDA is not relying on pre-cessation triggers. But ISDA is a sort of a different animal, and that would be a whole nother discussion as far as how they're dealing with it, which is eventually going to be by protocol and and presumably a big bang on one date where they're just going to change over. So the way forward and ARC's best practices, you'll see here. So the first one, they're saying all new loans should have the hardwired approach as soon as possible, no later than September of this year. You know, that's aggressive, you know, for the reasons, you know, Malcolm raised. People are really hesitant to agree to something that they don't know what it's going to be. ARC's recommending that all third-party technology and operation vendors complete enhancements to support it by September 30th as well. You know, the market needs to have confidence that the back offices and you know, calculations will work and that everything's in place. So that's really what's going on there. It's to, you know, provide the market with some confidence. The third recommendation is that no LIBOR loans shouldn't be originated after June 30th, 2021. You know, that's only 6 months before LIBOR is supposed to go away. So so I guess you have two choices there. One would be to, you know, originate a LIBOR loan. You know, up until that point, you can originate a LIBOR loan with the, you know, hardwired amendment approach. And then they're saying after that, you know, you should just be using SOFR documents. The LSTA has published two sort of concept credit agreements, one using compounded SOFR and another using simple SOFR, you know, to deal with, you know, interest rate determinations and interest periods and all of that, to deal with the backward-looking nature of that. So they published those concept credit agreements and took comments on them, and you know, we'll presumably keep working on that and publish, you know, their sort of final versions of it. You know, I took a look at those. You know, they're you know, it's a different animal, right? Because it's again, you got to get the interest rate on a backward-looking basis. And their fourth recommendation is that if a loan allows party discretion, you know, this only applies to the amendment approach, the selecting party should choose it at least 6 months in advance of the effectiveness of that rate, in order to, you know, give folks time to work it out and to make the amendments that need to be made. So you know, in 2017, a lot of this seemed far off and manageable. Maybe it didn't seem manageable, but it seemed far off. But it's certainly feeling less so today as we sit here in mid-2020.
I would just say that the dates on that timeline are going to be upon us any moment now, and so LIBOR really is going away. It's going away soon, and you know, hopefully the back office operations teams will have spent the time necessary to operationalize SOFR, which seems to be the de facto replacement, such that it becomes usable, so that when we get to you know, the last 12 and then 6 months of LIBOR, we really can do a responsible transition to SOFR without losing things in the translation. And that's going to be a real challenge for the entire lending market. And you have to keep in mind that compared to the derivatives market, the syndicated loan market, and even smaller, just the real estate loan market is very, very tiny. And so those markets are tiny, and the derivatives market is huge. And so you can imagine that the derivatives market is going to see a transition happen. It's, as Mike said, it's probably all going to happen on a single day. And it's going to be all geared toward what works for the derivatives market. And what works for the derivatives market probably won't work for the syndicated lending market. And so for the syndicated loan market to have a good transition, you really need to understand what is the derivatives market doing and how can we build on that and turn it into something that works for syndicated lending. And that's the challenge that everyone is facing right now and working through. So with that, let's move to Reg W. You know, we think of Reg W is something that it's important for everybody to know a little bit about. Reg W is part of the Federal Reserve Act. This reg came out in 2003 following some bank solvency type failure type problems. Basically, the point of Reg W is to say to banks, listen, we know that you have banking entities and non-bank entities that are affiliates. We know, for example, that because of other regulations, the investment banks must remain separate from the traditional commercial banks. And so we can't have a situation unfold where you're using your bank affiliate to prop up or make profitable your non-bank affiliate, such that your bank affiliate then runs into financial difficulty. And so Reg W is designed to keep banks from running into financial difficulty by reason of their business in relation to their affiliates. So there are some defined terms where affiliate is defined quite broadly to include parent companies and other subsidiaries and companies under common control and with interlocking boards, et cetera. They're trying to pick up any affiliate you might be inclined to prop up with your transaction activities. And the truth is banks are pretty good about compliance with this, and enforcement actions are pretty infrequent. And but there are a couple of items that people have run into that we're going to run over. And so let's go to the next slide. Okay, so we see a little flow chart of securities affiliate and a bank affiliate and a third party. And so a covered transaction would include certainly a loan directly from a bank to its affiliate, or a purchase of securities or other assets from an affiliate, or taking an affiliate's securities or debt as collateral, or giving a bank guarantee to benefit the affiliate. But there can be some third-party transactions that wind up being included as covered transactions within Reg W, and those include if a bank makes a loan to a third party and the proceeds are used to somehow benefit the non-bank affiliate, like fees to a non-bank affiliate. And so this comes up all the time because it's very customary for non-bank affiliates to act as arrangers in syndicating loans. And if you have a non-bank affiliate acting as an arranger, and there's an arrangement fee payable at the closing of the loan to the arranger entity, and it's not a bank, and the borrower comes along and says, what would be convenient for me, bank? What would be convenient would be if you fund it on a net basis, and all the costs, including legal and fees and everything else, just got netted out of the proceeds you're giving me. Well, if the bank does sort of a net funding and is funding transaction costs out of the loan, and therefore the proceeds are being used to pay its affiliate's fee, you've just created a covered transaction for Reg W purposes. And what we tend to see in the situation I just mentioned is transactions where in the fee letter, the non-bank affiliate would say, notwithstanding anything to the contrary, you will not under any circumstance pay our fee out of the loan proceeds. The problem with that is, there were often transactions in which, from a practical perspective, the borrower really didn't have any opportunity to pay the fees out of any other pot of money besides the loan proceeds. And so these covered transactions were happening like it or not. And even if you put self-serving language in a fee letter, in fact, when you got to the execution of the transaction, sometimes the loan proceeds would wind up being used to pay the bank fee, and that's not good. And while banks are allowed to engage in these covered transactions, up to 10% of the bank's capital across all its affiliates, 10% with a single affiliate and 20% with all its affiliates. What banks try to do is not have any covered transactions, so that if in fact they wind up with some covered transactions, they haven't used their buckets of 10% and 20%, up entirely, so that if they discover they inadvertently had some covered transactions, they can put them in the bucket. So they really try not to do this. And that's why you may have noticed recently that a number of banks have started naming their bank entities as the arrangers of their credit facilities, because they've had so much trouble complying on the fee side with the Reg W requirements. They've thrown up their hands and decided that they're just going to use their bank affiliates as arrangers, even though that's not quite as advantageous from a profitability standpoint, et cetera. So let's go to the next slide.
Okay, thanks,
Okay.
Malcolm.
We're going to move. Yeah, we're going to move now into HVCRE reform, and Zach has had time to learn everything there is to know about HVCRE reform, like what HVCRE means. So take it away, Zach.
So I've learned that HVCRE stands for high volatility commercial real estate loans. So HVCRE was implemented by the Basel Committee, which is, as you probably know, an international forum of member countries that work together to try and establish best practices in banking oversight. It was implemented in their Basel III Accord, which was in 2013, and it was a reaction to the late 2000s financial crisis. So this is what introduced this new category of loans called high volatility commercial real estate loans, or HVCRE. So these are loans that I will describe in more detail on the next screen, but they have to be reported separately from other commercial real estate loans, and importantly, they have to be assigned a capital risk weighting of 150%. So following the Basel III Accord in 2013, Congress passed a reform bill in 2018 that had a lot of significant reforms that we'll talk about on the coming screens, and clarified exceptions, et cetera. And then recently, the Federal Reserve, the FDIC, and the Office of the Comptroller of Currency released the final rulemaking, which is effective as of April 1st of this year. So that's pretty recent.
And so just to put this into context, when we say that HVCRE loans have an assigned capital risk weighting of 150%, a non-HVCRE loan would in general have a capital risk rating of 100%. And so these are, half again as expensive from a capital risk weighting perspective than other loans. And the result is that the banks actually have to show the regulators that they're holding capital in reserve up to this, percentage, for HVCRE loans. And so, as we were saying in the LIBOR discussion, it's important for a bank to try to make loans that where their return is exceeding their cost of capital. If you had a loan that you thought was not an HVCRE loan, and you decided it would be profitable to be in the business of making loans like that, and you were in that business, and then all of a sudden you discovered that all the loans you had originated were in fact HVCRE loans, and they needed to have capital risk ratings of 50% higher. All of a sudden, your cost of funding those loans, went up substantially, and it may turn out that all those loans are just a big loss for your bank. And so it's a big deal for the bankers whether or not loans classify or not as HVCRE loans from a mere profitability standpoint. And the result has been a number of banks have basically exited the construction lending market because of the fact that HVCRE makes their construction loans so much more expensive from a risk weighting perspective.
On this slide, we talk about the types of loans that the HVCRE rule applies to. So it needs to meet the three criteria that are set forth at the top here. So as we said, it has to primarily finance the acquisition, development, or construction of real property with the purpose of turning that property into income producing, where the loan is going to depend on the income produced from the property for repayment. Again, through the different reforms, different exemptions have been clarified, but the current exemptions are set forth here. So those include, residential projects that are 1 to 4 family homes, and the 2020 rulemaking clarified that does include condos and co-ops that had previously been a bit of a gray area. Other items that are excluded are agricultural loans, community development loans, loans with loan-to-value ratios below maximum applicable levels, and where the borrower has contributed cash equity of at least 15%. We'll talk on the next slide about what items do and don't count towards that 15% requirement. And then lastly, loans that have been sold, paid off, converted to permanent financing, and the 2020 rulemaking also clarified that projects that have been stabilized are carved out. So, stabilized where income from the property covers property expenses and also debt service. So the 15% contributed capital requirements can be a little tricky, and I think we tend to see people get tripped up on this and not know what is or is not included.
And so just to jump in here on this, the reason this is important is because the amount of capital that a borrower has to find and contribute as equity is a big deal to the borrower. And so this comes up in the negotiation of the term sheet for the financing in a big way. And the borrowers really need to know exactly how much capital do they have to find and contribute to the property, and how long does that capital have to stay in. And because it's not easy to find equity capital when what you're used to is leveraging your projects and paying for everything with debt capital. And so, whether some particular type of purported equity capital is or is not eligible to count toward this 15% is really where the rubber meets the road from the borrower's perspective. And the lender has to get it right, or else they've mispriced the deal.
Yeah, and again, the various reforms have helped to clarify what can and cannot be, included in the contributed capital requirement. And through the different iterations, it's those have been kind of expanded. So on the left-hand side, we have items that are eligible to be counted towards that 15% requirement. So those items include, cash paid by the borrower to acquire the site, or at cost land purchased and then contributed by the borrower to the project, out-of-pocket development expenses, and also proceeds from preferred equity sales. And then in the right-hand column, we have items that are not allowed to count towards that 15% requirement. So obviously, borrower real estate that's pledged as collateral from unrelated projects, deposits collected by developers on condo units, other liens, so second lien mortgages, and also mezz and other types of financing of the project, and then assets contributed after the first advances and cash grants.
And so notably, you can't say to your borrower, okay, we'll fund side by side and you'll put in your 15% as we put in our debt capital. The borrower money has to come in first.
And thanks, Malcolm. And so this is a helpful slide. Again, it can be a little confusing, but this is a helpful slide for knowing exactly what does and does not count towards this requirement. So on this and the next slide, we'll talk about HVCRE reform through the years. This is easily one of my favorite pieces of clip art for what it's worth. So, as we were talking about in the previous slide, previously, only the actual cost of the project could count towards the 15% borrower contributed capital requirement. But the 2020 rulemaking clarified that you can now use the appraised value of the project towards the 15% requirement. And similarly, before the 2018 reform, all of the borrower contributed capital had to remain in the project, even if it was internally generated returns. And now only capital that's equal to 15% of the appraised as completed value has to remain in the project. So that was a helpful clarification that came from the 2018 reform.
Yeah, and these were really important because borrowers and developers would acquire assets sometimes decades ago, and then they finally get to the point where they were developing them. And if you could only count the value of the capital you contributed when you contributed it, as opposed to what is it worth today, that could be an enormous difference in value.
So we spoke about this earlier, but previously projects that had been, or loans for projects that had been substantially completed and stabilized were not allowed to be reclassified. But now if you have a project that's been substantially completed and is stabilized so that income from the project covers not only expenses of the property, but also debt service, you can take that off your books as an HVCRE loan. And then similarly, all tenant improvement loans were previously subject to HVCRE rules, and they've now carved it out so that small TI loans that are on projects that have been stabilized are excluded.
Yeah, that was a big deal because there were many loans that fell into the category of, well, you had some tenant improvement loan component to them, and now you were going to classify the entire financing as an HVCRE financing, even though no one had contemplated that that's how the regs would classify that loan. And so that second one was a really important reform.
Yeah, and I think that that was one of the areas that CREFC gave some comments on, and I think that was one of the areas they were targeting. Turn to the beneficial ownership rule, which Malcolm is going to talk about.
So beneficial ownership, this has to do with knowing who your customer is when you're a lender. The loan servicing and loan syndications and trading association beneficial ownership form. It's a pretty simple seeming form. You basically trace ownership up until you get to a person or a publicly traded company, or until you get to actual people who own individually less than 25% of the equity interests in the entity to which you're lending money. And this is a rule where that applies only to covered financial institutions, which basically are U.S. banks. And so if you're not a U.S. bank and you're lending, you don't need to comply with this. As a practical matter, however, a lot of non-U.S. bank institutions nonetheless have adopted beneficial ownership rules, internal rules, just like this. And you'll see insurance companies doing this, for example, because the thinking is if you don't self-regulate, even if you're not required to, and you wind up facilitating fraud and money laundering, the regulators are going to come in and regulate you, and you may not like the way the regulators regulate you, and so you better comply with this yourself, just the same way banks do if you're making any kind of significant loan. So what do you have to do? You have to identify all the beneficial owners. Basically, you start out with a structure chart, and then you send the form, and the borrower's counsel and the borrower help fill out the form, identifying all the natural people with significant ownership, that's basically how it works, just as you would expect. Sometimes you get responses back saying, well, we really shouldn't have to fill this out because no one's ever required us to do it before, or that information is confidential, or other arguments to that effect. When faced with those arguments, you should reject them, just like the cartoon suggests on the right-hand side. Financial institutions are required to develop their own procedures on this. Some of them have more exacting procedures than others. In particular, European financial institutions may have more stringent demanding requirements than U.S. institutions, simply because in Europe, the laws on KYC type topics tend to be more exacting, and so they'll ask for things like copies of passports and driver's licenses and documentation that we're not used to seeing, but that's what their internal procedures are, and we should go out there and try to get these records, because each bank is required to follow its own internal procedures and be able to demonstrate to its examiners that that's what it's done. And so just because some banks don't necessarily require a copy of a passport or driver's license doesn't mean that it's not within the purview of other banks to be able to do that. And so that's what we wind up in the middle of. I think at this point, there are some beneficial ownership guidelines that some of the industry associations have come out with that the U.S. banks tend to follow, and that has worked well because it's less of a free-for-all in terms of what the requirements are from a documentation standpoint, at least for U.S. banks right now. That takes us to flood and terrorism insurance, and how we manage to meld those together into a single topic is anyone's guess. But the person who's learned all about that is Zach Aries yet again. And so, Zach, why don't you regale us with stories on these topics?
The National Flood Insurance Program, aka the NFIP, was established in 1968. It's administered by the Federal Emergency Management Agency, and it provides federally backed flood insurance to property owners that are located in participating communities. So, in our context, it mandates flood insurance for loans, and that's at the time that the loan is made, increased, renewed, or extended, which is an important note and something we'll talk about later on, in loans that are made by lenders that are federally regulated, that are secured by buildings in flood zones, and that are located within communities that participate in the National Flood Insurance Program. So, at the outset of a deal, you should, lenders have to obtain a flood hazard determination. Again, we'll talk more about this later, but we always think it's a good idea that if you're working with a bank that tends to get their own flood determination, we should also be getting one.
Yeah, it's not unusual for our flood determinations to come out somewhat different from other lenders' flood determinations, and that may be because, for example, we get our flood determinations done generally on a building-by-building basis, and so if a property is right at the edge of a flood zone, for example, our determinations may indicate that the actual buildings are not in the flood zone, whereas if the lender just ordered a flood determination based on a street address, they may get the opposite result. The other thing is that federally regulated lenders, that means basically all banks, U.S. or foreign. If your client is a foreign bank and they're wondering whether they have to worry about the flood regulations, the answer is yes. And so don't get fooled into thinking that it doesn't apply to foreign lenders, because it does, at least foreign banks.
So again, if it is in a flood zone, then you need to provide a notification to the borrower and have that executed. And the borrower must then provide evidence of flood insurance, which must cover the buildings, but also the contents of those buildings that are located in the flood zone. In a few slides, we'll talk about some best practices, to use if you are in fact working with buildings that are located in the flood zone.
So you'll often get questions from lenders about, well, do we really have a lien on the contents? Do we have to worry about contents flood insurance? And the answer almost always is yes, we do have a lien on the contents, even if nobody thinks the contents are anything very much, because whoever heard of a mortgage without a security agreement built in that covered contents? And so it doesn't have to use the word contents to mean contents. If it covers personal property, that means contents. So, always be thinking about both the building and the contents coverage when you're thinking about flood insurance issues. The other thing is the flood insurance program only applies if you actually have a lien on the real estate. So, if you're doing a mezz financing or something where it's unsecured or secured only by equity pledges, you don't have to worry about the flood insurance program. And sometimes clients don't realize that, and they spend a lot of time worrying about flood insurance in the context of deals where you don't really have a lien on the real estate.
And obviously, if you're working with an unsecured facility that becomes secured at a later date, that's just something to keep in mind as well. So the National Flood Insurance Program is funded by the National Flood Insurance Fund. If there are gaps in that fund, then the Treasury makes loans to cover those gaps. So for instance, after Sandy and Katrina, the National Flood Insurance Program borrowed in excess of $25 billion to cover those gaps in the fund. Congress has to periodically renew the National Flood Insurance Program. So it was most recently reauthorized in 2019 for a year, and so it's now, it's now current through September 30th, 2020. The program has lapsed in the past, which prevents new claims from being filed and new insurance from being obtained. The Trump administration had plans to completely overhaul the National Flood Insurance Program. Specifically, FEMA was going to release a new rate premium structure, and they were planning to release that, I think, early 2020 with the goal of having it implemented by late 2020. But those plans have now been pushed, and so I think that the new rate structure is now not due to be released until late 2021.
So there's some thought that the number of floods or of 100-year floods has dramatically increased in recent years, and there's some thought that that has something to do with global warming, and so the National Flood Insurance Program, as you can tell by the chart on the screen, is operating in a manner that's pretty insolvent by billions of dollars. And I know it's shocking to think that Congress would set something up that's would consistently operate over many, many years, on an insolvent basis. But that's what we have, and it's not likely to get any better anytime soon, given what global warming means for the odds of a major flood.
This page, we have some really helpful best practices that you should be following with relation to flood. I find this to be a really handy resource. It's pretty easy to forget to do some of these things. So, at the outset of the deal, it's important to make sure that both your term sheet and then the credit agreement have customary provisions for handling flood compliance. And it's important to note that your credit agreement needs those provisions, which, talk about obtaining flood determinations and the borrower providing evidence of insurance if anything's in a flood. You need to have that language regardless of whether the property is or is not in a flood zone. So Malcolm, I think Mike and I had a deal recently where we knew that we had the language in there, and we knew that the property was not in a flood zone, and so the borrower just scrapped that language, and we had to set it back, to make sure we're still in compliance. So that's something that I see come up all the time. As Malcolm alluded to with the beneficial ownership rule, banks here have very disparate internal processes. Some really dig deep into this. Some order their own determinations. Others rely more on us. And so it's just important to be mindful of that, especially when you're in a deal with lots of syndicate lenders too. It's easy to run up high costs, liaising with the syndicates on their different flood processes and flood questions. So it's a good, idea to talk to your clients about how to handle that. I've certainly, had clients or borrowers that don't want the law firms playing middlemen when it comes to handling flood compliance.
And so it puts us in an interesting position, because on the one hand, we could have clients who are heavily relying on us to ensure that they comply with the flood regulations, yet their borrowers may be saying, we don't understand why the lawyers are involved in insurance matters, keep the lawyers out of this. And so there's a bit of a tension there, and we try whenever possible to make clear to our clients that we're not holding ourselves out as insurance experts, we're legal experts, and if they want to know whether or not they've complied with insurance requirements and whether proper insurance policies provide proper coverages, they really need to engage an insurance expert to tell them that. And so we often will work into our email correspondence with the client that we recommend that they engage an insurance expert or an insurance consultant, and we can make recommendations if they don't have one, because we need it to be their decision not to engage one if in fact they decide not to do that. And in the banks that have flood groups within the bank who confirm compliance with the flood insurance regulations, have insurance experts within those groups who really, spend day in and day out reading these insurance policies and confirming that the coverages are correct. And, we really, do need to defer to the experts on those kinds of topics.
So the next item is on here. Well, as I said earlier, it's always a good idea to be ordering our own flood determination, even if the bank orders their own. And the next item is, if you have a building that is in the flood zone, you should immediately send the list of diligence questions that is in part contained on the sample email that we provided in the materials to the borrower. That there's about 8 or 10 questions on there. Talks about the value of contents and buildings and where the different buildings are located. That can sometimes be really helpful when you're doing a building by building flood analysis as well. As Malcolm spoke to earlier, it's really good to emphasize from the outset that contents must be insured. I've had good luck just kind of explaining that from the start, rather than trying to field questions about it after you inevitably get those questions. Again, as we spoke about earlier, it's also really important to perform a building by building flood analysis. And kind of gets to what Malcolm was talking about earlier. It's possible if you just run a flood determination on an address, you might be in a flood zone, but if you go on a building by building basis, you may not be. One situation that I've encountered multiple times is, a situation where you have one small building like a shed or a shack that is very immaterial to the collateral pool and to the loan value. That is the only parcel or building that's located in the flood zone. So if you find yourself in that situation, you can consider trying to artfully exclude it from the mortgage, based on discussions with the borrower. And if you find yourself in that situation, which I imagine most of you have, but if you haven't, you can certainly talk to Malcolm, myself, or Todd about different ways to artfully do that. I've done it in the past by listing out coordinates of excluded property. I've seen images of certain buildings used, although I've also had recorders reject that. So there are different ways to go ahead and do that. The next item is that, again, if you have a big syndicate where some of the syndicate lenders are not comfortable with their flood diligence by the time you are trying to put the mortgage on, those syndicate lenders can actually send a letter to the admin agent disclaiming their interest in the mortgage, and then later on, if and when they do get comfortable with flood, they can actually go ahead and revoke that. But Malcolm, correct me if I'm wrong, I think in a foreclosure situation, that's not effective, is that right?
Well, it's a strategy of last resort. I mean, basically, it would be a situation where the lender is already in the deal. Some additional collateral is being taken. I mean, this is how it usually comes up. Additional collateral is being taken. They can't get comfortable with the flood insurance. They don't want to hold up the deal. The asset at issue is not so material to their underwriting that they want to exit the deal if the mortgage isn't being, if the mortgage is taken, or if they don't get the benefit of the mortgage, it doesn't affect their underwriting that much. And so they may decide that they could get comfortable disclaiming their interest in the real estate that is in the flood zone, and letting the other lenders have the benefit of that mortgage, unless and until the individual lender can get comfortable. It's something where they have a piece of paper that they can point the examiners to say, listen, we identified some problem in the flood coverage for this building, and so we weren't able to get it addressed, and so we disclaimed our interest in this mortgage rather than be in violation of the flood regulations. Here's a letter confirming it. And so it's not a perfect situation, and again, just something that could be pursued only as a matter of last resort, in my view.
Thanks. As we spoke about earlier, you have to make sure you're in compliance with flood regs, not only at the outset of the loan, but anytime the loan is extended or increased. And so because of that, it's really important to make sure that you're avoiding any dragnet provisions in the mortgages that just capture any future debt issue. I think we tend to see this come up a lot with smaller community banks that are making relationship loans to their borrowers, but it's hard for banks to keep track of these items, and so if you have dragnet provisions, it's possible they'll run afoul of flood regulations if it's capturing new debt down the road.
So just to be clear, a dragnet provision is a provision where you say this mortgage secures the XYZ loan in the amount of, say, $3 million that we're making today, and then there's a clause a little further down that says, and this mortgage further secures any other obligations that the borrower may at any time have to the bank. And if you say that, then anytime the bank extends any further credit to this borrower, it's secured by the mortgage. Well, one of the tripwires for flood compliance is increasing the amount of the loan. And so that's secured by the mortgage. And so if now you make an additional loan of some kind, no matter how small, to this borrower, where you've just tripped a new flood compliance event, and you have to go through this flood compliance thing all over again. Well, who's keeping track of that? I assure you, no one at the bank is keeping track of that. And that's why dragnet provisions are so dangerous, because you just wind up with violations all over the place if that's what your form of mortgage says.
And then the last bullet point on here, the regs are silent on property that's acquired through debtor in possession orders. And so it's important to note that it's, a little bit of a gray area, but they're still subject to the flood insurance requirements regardless of how you obtain that property.
And as a practical matter, often in a DIP financing, you may not be able to, as a practical matter, comply with the flood regulations, and you should just do the best you can to demonstrate that you tried to comply, because the financing is going to, in all likelihood, go forward regardless of whether you've complied, and at least you can show you tried. And you want to be able to at least be able to demonstrate to the examiners that there was an attempt made to comply with the flood insurance requirements in that circumstance. And maybe one day the regulations will be modified to address this situation, because they don't address it at all right now, and it's a continuing problem for bankruptcy financings.
So the next slide is just a quick few bullet points on terrorism insurance, which came about as a response to 9/11 when it was hard to get terrorism coverage. I'm actually pretty curious to see what happens now. I think we're probably going through a somewhat similar situation where, I think prior to 9/11, I don't know how much at the forefront of people's minds terrorism insurance was, and I'm now curious to see, pandemic insurance moves, in addition to business interruption insurance, obviously moves towards the front of borrowers' minds. So I think that's just an interesting thing to watch out for. So the Terrorism Risk Insurance Program was created again as a response to 9/11 in 2002 by Congress, and it's a federal backstop for terrorism insurers. Like the National Flood Insurance Program, it also has to be periodically reauthorized, but recently the flood insurance program has been extended for a year at a time. In late 2019, however, Congress reauthorized the Terrorism Risk Insurance Program through late 2027. And similarly, unlike the National Flood Insurance Program, where the administration has presented a desire to reform, no notable reforms have been presented to date by Congress with respect to terrorism insurance.
Yeah, so similar to flood insurance, it expires from time to time, but fortunately, it's been extended pretty far out at this point. And so the important thing is it doesn't look like it'll disappear anytime soon, which is great for the real estate market.
We're going to talk about the QFC stay rules. So QFCs are qualified financial contracts, hedges, swaps, derivatives, repos, etc. Dodd-Frank, again, in response to the crisis, enacted these rules basically to enable the banking regulators to wind up the affairs of QSIBs, DSIBs, globally systematic important banks, and they're, in the event there's a, they run into trouble, as folks like Lehman and Bear Stearns did back in the day. And it's basically what it does is says that counterparties to these entities agree, notwithstanding that their contracts may be governed by New York law, you basically are forced to agree to the resolution stay powers of the regulators. So that's really what it is. It applies to credit agreements because sometimes hedging obligations, interest rate swaps that are related to the facility, are supported by a credit agreement and either in the waterfall or they're collateralized, and but the benefits of the credit agreement are going to be sometimes limited to either the existing lenders under the facility or lenders that were lenders at the time they initiated the hedge. And so that basically in a workout or resolution scenario, that would restrict the ability of regulators to transfer those contracts to a solvent bank or new counterparty. So basically, borrowers and lenders, everybody agrees that the QFC stay resolution rules apply in those cases. We have standard language in our foreign credit agreement that addresses this. It's kind of a check the box kind of thing.
It's not apparent to the casual observer why you might include this language in a credit agreement, and really it's because a credit agreement or guarantee that supports any kind of hedge counts itself as a QFC for purposes of this language requirement. And it will, if there are some restrictions, it's that first bullet under the second bullet there where it contains transfer restrictions. Almost every credit agreement will wind up flunking that bullet there and therefore require the QFC language. And when you think about it, what the regulators want to be able to do is they want to be able to sift through the assets of a failing financial institution and put the good assets in one spot in one entity and the bad assets in another entity, the good bank, bad bank scenario. And wherever the hedges are moving, they don't want the result to be that they've moved the hedges, but the hedges now don't have the financial credit, support that the hedges were intended to benefit from come along with them. And so that's why this warning language is in there, because everyone, once that language is in there, everyone has agreed that no matter what happens in this financial institution insolvency type resolution situation, the credit support that goes with the hedges continues to run to the hedges wherever they may land. So that's why it's important. It's sort of similar in concept to the bail-in language that you see, the European bail-in language that you see in all credit agreements to which European financial institutions are party. So
yeah, and obviously, in a Lehman scenario, Lehman was counterparty to a lot of hedge agreements, and people just started to terminate them, and that's the scenario where it sort of destabilizes the whole system. So the resolution authorities, they want the ability to sort of stay those terminations and have time to work it out, and again keep things on an even keel and not have everything sort of be on the brink of disaster.
Thank you for taking the time to watch this webinar. We wish everyone watching well during these difficult times. We hope you and your families are all staying safe and healthy. If you have any questions or would like to discuss any aspect of the presentation, please do not hesitate to reach out to any of the presenters. We look forward to hearing from you.